Thank you for joining us again. This particular presentation is dealing with trauma insurance. Trauma insurance I'm seeing more and more regularly now as part of our superannuation fund expenses. Quite common that I see this bundled now in the superannuation fund. Typically the types of insurances that I'm seeing bundled in the fund are life and total and permanent disability insurances. There are some others, but typically they're the two that I see bundled within the fund and that are quite easy to bundle within a superannuation fund. Of course, the level of insurance has to be considered, and the most common factors deciding or in relation to the level of insurance has to do with the availability of the cover, the automatic acceptance levels, sometimes because of the poor medical conditions that we may have or the difficulty we have in health, that it may be difficult to get life cover, and so some insurance policies have got automatic acceptance levels that they'll let you in without any medical, without a doctor signing off or any other medical requirements beforehand. And so automatic acceptance cover is generally a low insurance cover, but hey, some insurance is better than none. And sometimes the other area that has to be looked at is affordability of the premiums. The ATO was issued most recently in the first month of this year a determination with some guidelines in relation to trauma insurance within superannuation funds. These guidelines are of course just that, guidelines, and sometimes they're being or it's being used to sometimes overcome some of the difficulties of understanding, where you have an insurance agent telling you one thing and you have your accountant or your auditor telling you something else. What's been good about this is, as a result of the determination coming out, the industry itself has decided to do a little bit of its own regulation, and a number of the policies have been brought out specifically for self-managed super funds to have, and also they've done a bit of a shake-up themselves, and so it's probably a good prudent time to have your life cover looked at, whether it's within a super fund or not, to have it looked at independently, away from or from a different person that's currently doing your insurance work, because they have a vested interest to or conflict of interest. They can't give you something that's totally independent, and so it's a good time to have your trauma insurance reviewed. Some salient points in the determination is it must be you must be assured that the policy owner is the super fund, and the life insured must be the member. Some of the common problems that we see is that members are the policy owner as well as being the life insured, but the policy owner must be the super fund. Be careful that exiting members of the fund don't continue to have the fund listed as their policy owner, because in the event of them dying, even though they might be not a member of the fund anymore, you'll find that the insurance company will pay the benefit to the fund and not to the estate, and that'll cause some trauma and upset for those people. Remember that the benefits must be payable to the trustees of the fund and not the life insured. So just be aware that upon a claim being made, it'll be paid to the fund and not to the life insured. And of course the benefits will form part of the assets of the super fund until such time as a condition of release is triggered by the member. Generally, in most trustees, death is a trigger. Not always, but it should be the case in any superannuation fund that we've set up or had a part of setting up. The death of a member is a trigger or a condition of release. Be careful with respect to disability. It's really important in your policies as to what's if they've got total and permanent disability in there. You've got to look at the fine print as to what is classified as being disabled, as well as someone who may receive or may have an urgent medical problem which could cause death, serious enough to cause death within 12 months. Sometimes the policy will allow that payout before the person has passed away, because they're unlikely to live. So that's something that could be considered as well. Paragraph 18 of this determination has also something interesting in there. And I quote, "In determining whether to offer trauma insurance, trustees should consider factors such as proportioning of the contributions applied to the purchase insurance cover and an unreasonable diversion of contributions to purchase premiums for the contingent trauma cover will be difficult to reconcile with the sole purpose test." What that's basically saying is simply that the costs of getting trauma cover for Mel should come out of Mel's contributions, not out of Mel and Lynn's contributions combined. That I should put sufficient contributions in the fund to at least cover my my trauma insurance. That's that first section. And the second section is basically saying if it's seen that a disproportion or unreasonable diversion of contributions is put towards trauma insurance cover and basically nothing else, then really what is the purpose of setting up the super fund at all? It's not being set up for the purposes of providing retirement benefits for members. It's basically being set up for the purposes of putting contributions in and getting a tax deduction for the premiums of the life of the trauma insurance. So how does this transmit to other insurance policies held by the fund? Where the case is only one investment, this is a life policy. That's a question that has to be answered, and I believe if basically there's not much left in the super fund after paying the trauma insurance policy premiums, then you are in breach of the sole purpose test. What does your deed say in regards to how the proceeds of the policy are held until the member condition of release is realised? All the deeds that I have in there handle that matter quite expeditiously, and that the time periods of receiving the premium and meeting the condition of release is quite quickly. But other deeds I've seen have periods of 3 months and 6 months, and the trustees of the super fund have all sorts of discretion in there which can hold the executor of the deceased estates to ransom. And of course extreme care must be taken in what and how to bundle trauma in a self-managed super fund. It really is, there is a need to speak to an expert on this. It's not just a common insurance salesman can do this, but someone who actually knows a little bit about it and can handle this. In summary, it's good to have trauma cover in your super fund. Care needs to be taken with regards to its dominant purpose, and of course new and existing policies need to be checked. We recommend an insurance agent by the name of Steve from BEPS. I'll put his phone number on there. Steve's pretty straightforward, straight up and down. He's independent. He doesn't act just for one company. He's not just a Suncorp man or anyone else. He's a proper agent and independent. He's true right and holds all the proper licenses. And I found his insight and his grasp of law quite of a high standard, and I have a quite deal of respect for what he suggests. And so for no cost, and you don't have to be local, you can give him a call and give him an opportunity perhaps to have a look at what you've got, and he'll give you an independent advice on it. Thank you very much.